Hi, my name is Benjamin Faust, instructor of economics, and I would like to go over with you briefly the difference between fiscal and monetary policy so you can distinguish them easily in your mind. Fiscal policy has to do with the government's taxing, its spending, its budgeting. If it refers to taxes, debt, spending, switching which kind of taxes, switching which kind of spending, anything like that, issuing debt to pay the bills, that is all fiscal policy. If, on the other hand, it has to do with anything related to the money supply, if they're expanding the money supply for a reason, or if they're shrinking the money supply for a reason, that's monetary policy. Now, if you've ever been on a diet kick or a health kick, you might have noticed that in the ingredients label, it has many different words for, let's say you're trying to get rid of sugar, so the ingredients label will have different words for sugar. It might say brown rice syrup, it might say sucrose, it might say dextrose, it might say high fructose corn syrup, all different forms of sugar. And so we might have some other phrases we hear rather than just reduction or expansion of or change in the money supply. You might hear something like interest rates, because that is essentially when the Fed, the United States Central Bank, is raising interest rates, what they're doing is they're shrinking the money supply by just a little bit in order to force the interest rates up. When the interest rates are falling, when they're pushing down interest rates, they're expanding the money supply just a little bit in order to get the interest rates to go down. And so it might sound like interest rates, might sound like government is accommodating the system by pushing in cash to keep banks afloat, something like that. If it has to do with the money supply, it's going to be monetary policy. If it has to do with taxes, spending, or debt, it is fiscal policy.